I'm more of an Excel guy than a PowerPoint guy. So what I'm going to do is share my screen, which I'm going to try to blow up to make it easier to view and talk about buying property in mainly a family trust and a self-managed super fund. But obviously, a general basis is a good starting point. Generally, people buy a property, they pay the price, let's say that's $500,000. They'll have to pay stamp duty on the purchase of the property. These are old rates. They're not necessarily the current rates. Let's say you pay about $2,000 for conveyancing or legal fees. You might have some bank loan or other costs. And so that becomes, in this example, 20,000 is the total cost to buy a $500,000 property. And then that becomes your cost base for capital gains purposes when you later sell. And usually what you would have put a deposit down of between 5 and 20%. Usually it's 20%. So I'm just going to put that. I'm going to put a negative 500,000 times 0.2, which is just, we've got $100,000 there as the deposit. So what that means is you might have also had to pay the $20,000 or, that, but in this example, we've got a $420,000 bank loan, and that could either be a interest only loan or a principal and interest loan. And let's say that we've just got that at 6% just for simplicity. Then obviously we could live in the property, but in this case, we're probably talking more about investment properties for trust and self-managed super funds. So we're going to rent it out. So let's say that we can rent it out between $470 and $480 per week. So we get rental income, we've got council rates, we've got interest on our 80% loan, we've got a property agent, we get a depreciation schedule which calculates the cost of the building, and we can claim the cost of the building over 40 years with a one-off schedule. And I give a referral to a great firm Duo Tax, who helps us provide those. And then after expenses, we're negative. It's called negatively geared. So this capital deductions is not a tax cost. That cost has already been put in there. But so let's say on our tax return, we've got a loss of $8,000, and then cash we've got to pay without the capital, but also it's more than that than what's in the tax return, because we also need to pay, if we've got a principal and interest loan, which is common unless you specifically ask for an interest only loan, you've got to pay down the principal as well. So this $400,000 loan, just going to edit this to be 6%. And then each month we're paying nearly $2,600. And most of that is only the interest. But the more that obviously we repay down that loan, the less interest and the more principal we're going to get. And over time, our monthly repayment, our principal component of what we're paying the loan increases. So over time, that goes substantially up. And, I've got here, we've got a date of freedom where the loan is repaid. Now, paying down loans is good, and there's an automatic saving to pay down that loan and using an offset for your excess cash. All of that's very good. But today we want to focus on, can we buy more property? Because generally, just from a logical point of view, let's say that, we've got a property value. Let's say we've got property values of $1 and property goes up by 5% a year. And then we hold that for 10 years. And let's say we times that, let's call it 1.05 is the 5%. So in year one, it's going to go up by $20,000. And in year 10, in year 10, the value should be $651,000. Obviously, it might not go up by 5% every year. It might only go up by 2% every year. Some years it might go up by 10%. Obviously, if it goes up 10% every single year, that compounding growth can be very substantial, massive. But forgetting what is realistic and not, buying a property in a well-positioned area that's about to become the next suburban area or the next thing, or it's just on the fringe and it's going to become popular, getting a buyer's agent to help you find the right property that's going to have capital gains could mean that you substantially grow your wealth and your asset base because of that. You know, anyone can find a property and make an offer and potentially buy a property that goes up by 2% a year. And obviously this is based on what you can do. Say you're a really savvy negotiator and you make offers on 50 properties, and then you get someone to accept your offer for 350,000 a year. You know, you've made $50,000 on the day that you've bought. But let's say that but it's only a 2% growth. So you could have bought it for 350 because of your savvy negotiating, but it's worth 487 when you sell it in 10 years. Whereas obviously if you buy in a better area and you get a 5 or 6% yearly return, that is a massive difference. And with capital gains tax, let's say that, you've got, let's call this a gross gain before costs. And then we've got all the purchase costs. Let's just for simplicity call that 5%. And then we've got the selling costs. Let's call that 2.5% because, you got the agent commission and you got advertising, that times that. And then let's say that we've got this minus this is your gross capital gain before main residence ownership and discount. So you might have mum and dad both own it, each 50%. You get 50% 1 year capital gains discount. That becomes that. So each mum and dad have got to put $70,000 of taxable income in their tax return. And let's just say for simplicity, this gives an example of what you would pay at the current marginal rates. So if you're above 190, 47%. If you're above 135, you're paying 39%. If you're above 45, you're paying 32%. And obviously if you split, you might pay an average of 35% because you're splitting these two rates, and the tax return will calculate that. When you're selling a property, either individually or through a trust distribution, you might be able to employ other strategies. One of the main ones is putting a deduction into super. And what you can do with superannuation is if you have a super balance, it's called a carry forward. What you can do is if your total super balance is under 500,000, you can put up to the concessionals your employer or you haven't made over, and those amounts have been 25,000 to 30,000 a year. Currently it's 30,000. So let's say over the last 5 years, there was a total of 130,000 that it was possible to put into super, and you had a job and you earned $100,000 in your job, and the average super rate was 11.5%. It's now gone up to 12. And then there's, you've put 11.5% a year over 5 years. So you've put 57,500 into super, or your employer has. You would be able to put an additional amount of 72,500 into your super fund in the year that you sell your rental property. And so there would be the potential to completely knock out this capital gain. And when we do the tax return, as long as you put the super contribution in during the year, when we do the tax return, we can decide how much of the super contribution we're going to claim a tax deduction on. So if you claim a tax deduction in your personal return, and this is a contribution made from your own funds. So, you have to have the cash to be able to make it. And usually we want the property to settle before middle of June, because that's when you need to put the cash into the super fund. But let's say you put in that full 72,500, and then we decided, well, no, hang on, we got our numbers wrong, or we don't need as much deduction. So we can tell the super fund, okay, no, we only need 65,000 as a deduction. And then in the super fund, they're going to send you a letter that says, yes, you can claim 65,000 in your tax return, and the super fund is going to make the super fund pay tax on 15% of those contributions. But you personally, you might get a tax deduction of your marginal rate, 32% or 37 or 39 or whatever it is. So you are it's hidden, but you have saved $11,000 in tax by putting money into a super fund with your capital gain on your property. So that's why I love property. If it's your principal place of residence, you might be able, you can have one principal place of residence and one for a couple. But if, obviously if you're single and you're not living together, you could potentially have one each. You having one property that's your principal place of residence, you can move out and rent it out for up to 6 years and not be taxed, not pay capital gains tax at all because there's a main residence exemption. Or if you move out beyond the 6-year period, you put a market value in for the cost as when you first started to rent it out and apportion the days, reduce the days and so on. So, sometimes people have these sort of figures, but when you reduce everything down, they've only got a capital gain of, something silly like $20,000. Sorry, it would be here, $20,000 before the main residence, and then you're only being taxed on $5,000. So that's why I love property and tax. I'm going to check the chat to see if there's other questions in there. There's not at the moment. So now I'm going to go on why I love discretionary trusts and super funds with tax. Discretionary trusts allows the lender to forget about all of your borrowing. So what typically happens is you buy an investment property or house and the bank goes, okay, what's your salary? Let's say you combine salaries 170,000 and the bank might go, okay, let's apply a rate of 5 times your income because you've got, nominated costs and so ever. And that's your maximum loan. That's just a rough guide, but we can help calculate your serviceability and all of that. But let's say that it's 170 grand combined income and they can get a loan between that 850,000 and 1,020,000 as the maximum loan. And let's say that that's 80%. So we can divide that by 80% and we go, okay, well, that means that they can afford a property between 500 and 1.275. I'm going to make that a bit bigger on the screen so it's easy to read. And so many investment property owners who are really keen on investment properties, and so many Australians only own one property because they can't afford to borrow to buy another property. It's hard enough, buying a property that you want to live in. So some people buy an investment property to be able to get a foot in the door, which is something I totally support, called rent vesting. But you don't, it's hard to buy more than one property unless you have cash from an inheritance or you've got a very successful job or income. But what is possible with a family trust is you can buy a property, and if the family trust, what's called, washes itself, it means that the tax return is positive. There's not necessarily negative gearing. That means that the lender can potentially forget about that debt when you go again to buy another property. So, back on this example of costs and tax, we've got a negatively geared rental property here. But let's say that we put a 40% deposit down. That's fine. That should now all kind of flow through an update. Yeah, there we go. Okay. So we've got in this example with that 40% deposit, we've turned it into positive in that we're making a very tiny amount per year before the depreciation. So that means the bank or lender can potentially forget about that debt and allow you to buy more than one property. So this is how, when you hear of people and they've got 6 or 7 properties and you're like, how the bloody hell could you do that? That is how. Either by, get extra borrowing as a as a property investing business and developing and all of this sort of stuff. There's more tiers and more complexity of what you can get up to. This idea of that the lender can forget about the family trust loan means that this property is in family trust number 1, and this is forgotten, and then they go again, and the lender says, okay, well, we're going to lend you another and lend you more money to buy property number 2. And obviously, if you buy well, you may be able to either sell a property and convert cash and pay some tax, or it may be possible to not sell and just re-borrow off the equity position. Because let's say that you have properties worth and your debt is 350, let's say that you had in this example, we bought the property for 500,000 and we've got a lot, let's just say that we've done the typical 80% thing. We've got a deposit and we've got a loan of 400,000. If the property goes up, and you've already paid the deposit. So let's say that the loan might slightly reduce in the time that the property increases. So you're always, even if you're not getting ahead with property, you're always kind of got this forced saving aspect of paying down the loan slowly that should repay when you sell it or refinance. So even if the property value hasn't increased, we've still got a little bit of a equity gain. So when you buy it, you've only got the equity of your deposit. If it doesn't go up, but you're paying down the loan, you've got the equity of what you've paid down in principal. But yeah, if the property goes up, and let's say it goes up to 700,000, you've got a massive equity position that you could potentially use to reborrow so that overall your loans don't total more than 80% of your property values. And then you can borrow on property 1 to buy property 2 and two and 1 to buy 3, etc. I'm not going to go spend much time on properties loan structure, but basically it is the purpose of the loan that makes it deductible. So let's say we've got property 1, which is PPOR, principal place of residence. It's not deductible. Property 2 is investment. You've used the funds from property 1, and you might need to secure that extra 100 grand loan against property 1.
Thomas.
But it's going
Thomas,
to be,
it's Chris here. You fixed.
the loan against property 2 the investment loan might have its own loan of up $300,000, but there's another loan that came from property that's secured against property 1. So it's not what the loan is secured against that makes it deductible, but it's the purpose of the loan. So because this loan was borrowed for the purpose of getting an investment, then the full $400,000 is deductible against the investment property. And obviously it goes in reverse. If you've got an investment property that's gone up in value and you borrow against that to buy your principal place of residence, then that loan is not going to be deductible. There are some ways to kind of debt recycle and do things, and that's a great thing to do as well. But thanks, David, for your comment. But overall, generally, you want to try to pay down principal place of residence debt that's not tax deductible. Generally, pay down debt is good, but some people keep investment debt for as long as they can so that they can have extra cash flow and buy extra properties. So we've discussed the main point of the trust, that you might be able to borrow more than one property, particularly if you put a higher deposit to allow the property to make money on paper. It's net positive for tax. A self-managed super fund, you can't necessarily borrow off equity and grow like that, but what you can do is you can potentially use your your retirement money in SMSF to borrow and then potentially buy a property. And with self-managed super funds, you need a self-managed super fund to invest in property. Obviously, if you have your regular super fund, I'll call it a retail industry or wholesale fund, you can invest in property equities like property managed funds, or obviously that's going to be invested by according to the choices that you've made. But you can't invest in direct property. You might be able to invest in, someone like Westfield is a listed fund that you could invest in. Now that's a specific financial product. Just to be very clear, I'm not authorized to provide financial product advice in terms of super is a financial product. I'm only trying to provide factual information and not provide recommendations for you to make financial decisions. Obviously, I recommend that you can get general financial advice from your retail super fund. You can get personal financial advice from a financial planner, or obviously you can decide not to go down those routes and go ahead to create a self-managed super fund on an execution only basis because you're like, look, I know what I'm doing. I want to go ahead with this. But yeah, definitely not wanting to provide financial advice, just looking to provide information to help you get ahead, but not information. I can't, and I'm not qualified to provide information about specific financial products. But your SMSF can be set up when you're interested to purchase a property. And then what the SMSF can do, you create what is called a bear trust, and either the lender or potentially we can assist in the creation of that. and then let's say that we're purchasing a $450,000 property, then in super, the loans are what's called non-recourse, so they're not going to attack you for the balance if you sell it and it's underwater. So that means the rates are slightly more expensive. But let's say, so we've got this $450,000 property. So that means with a 30% deposit, we need 150,000. Let's again say that we need 5% for costs, need another 22,000. So we need a total cash balance of over 150,000, which is transferred, which is withdrawn from your current retail super fund and put into your self-managed super fund, and then used to pay, it's used to pay the 5 or 10% deposit, and then used to the balance paid on settlement to purchase the property. And then the bank loans the difference of obviously the stamp duty and costs and the less the deposit on the settlement. And then you have a bank loan just like you would a regular mortgage. Now, the benefit with self-managed super funds and super in general is that contributions, now income is taxed at 15%. And so super fund income includes concessional contributions. So the 12% that your employer puts into super, they're claiming a tax deduction on that. It's taxed at 15% on the super fund. If you, I'm just going to finish off the example of the super fund, and then I'll go back and hit questions. So the super fund income is taxed at 15%, which is concessional contributions. If you make a non-concessional contribution, for example, low income earners under 50 grand approximately can put in $1,000 and get $500 paid in by the government, up to 50% on up to 1,000. It's called a super co-contribution, and it's something I've done in years past, for many years actually, whenever I've been able to do that. We've got the 15% on income. Capital gains get a 1/3 discount. So what that means is that super fund capital gains that have been held more than a year are taxed at 10%. When you are, and that's the regular thing, and that's called accumulation, and that's how that works. Now, if you have a negatively geared property in your super fund, that's going to reduce the taxable income of the super fund. And what you can do in your personal name is put in extra super contributions as long as you're under, either the 500 grand or under the 30,000 current limit per year, and that includes the 12% the employer is doing. As we kind of went back, let's say that we've got $200,000 taxable income, 12% super that the employer's putting in, which is 24,000, and we've got 30,000 as the current concessional amount. Then the person could put in an additional 6,000 into super as a personal deduction if they want to do that. For example, if the property is negatively geared, they want to pay down the loan, they could get a tax deduction at 47% or 39 or 32%, but that income is taxed at 15% on the fund. But because it's negatively geared, a self-managed super fund only pays the tax on its income. So, to the extent that you've got interest and you've got a negatively geared property, it's not necessarily paying that tax. So you're getting a tax concessional, you're building up property and paying less tax on the income of it, and potentially using personal deductions, which you get a personal rate, to then reduce a loan and increase the taxable income in your super fund. And then when you start a pension, which is either when you turn 65 or 60 and retire, or sometimes incapacitated, like if you've got some life-threatening illness or that type of thing, there could be some other reason you could otherwise meet a condition of release to be able to start a pension. Definitely if you turn 65 or you are 60 and retire, then the tax on income for the super fund is 0, and the capital gain is 0. And the only thing that you need to do in the super fund, and this after you've set up the pension, is that you have to take out a certain amount. You've got a minimum pension, which starts at 4 or 5% and then increases as you get older, from 65 to 75, 85, etc. those minimum pension rates increase. It is possible to take more than the minimum. I even heard a strategy when I was learning, the latest self-managed super fund strategies of someone who had bought a property that they intended to live in their super fund. And obviously you can't do anything with your super fund that's personal. And, they couldn't even spend a day there before they retired and started the pension and moved the house to themselves as a withdrawal, lump sum withdrawal. But yeah, they were able to transfer the property out of the super fund and have 0% tax on it. And then for their own name, have a market value purchase at arm's length. Let's say, let's say they bought it for 400 and then the market value was 800 when they retired and moved the property to them. Then they've got a market value of 800 grand as their cost base to purchase it personally, but it's all not capital gains exempt because they're living in it the whole time. And then when they eventually pass away, they could sell it within 2 years tax-free, or potentially, provide it to their kids, and there could be then becomes an investment property for the kids probably, or the kids could live in it and continue the capital gains free exemption. I'm going to take a quick break and look at the questions here. Feel free to add more comments in the chat or any further questions. So a question here is there a way to use the same structure but through the business and trust? Yes, you can. There's a principle in business and risk management that you want to separate assets from business because business has the risk of being sued and so on. So it is entirely possible to use the same trust that you're running a business in to purchase property, but sometimes people recommend that they're separate. Often people recommend that they're separate. Where you have a, let's say you've got a company that runs a business and you've got a family trust that's the shareholder, and commonly you would pay a dividend. Let's say, you have $100,000 profit in the company, you pay $25,000 tax, and you're left with $75,000 tax cash. In the next year, you might pay a $75,000 franked dividends with $25,000 franking credits. Now, if you had a property as well in that trust, and let's just make the numbers smaller for ease. Let's say you made $10,000 profit, and then you got $7,500 franked dividend, and we've got this dividend taxable income credit cash after tax paid. And if you've got a property in the same fund as a same family trust as shares, and the property is a loss, and so let's say the property loss is $10,000 and the overall taxable income of the trust is negative $10,000. Well, it might have to be 20,000 there to whatever make the numbers work. If you've got a loss in a trust, you lose access. The franking credits are extinguished. Whereas if you had $1 of profit in the trust, what you potentially would be able to provide is you would be able to distribute that $1 to someone, and that person would have $1 of income, but they'd also have 2.5 tax credits of franking credits that they could use to offset their personal tax. So usually the way to do that is to have a separate trust that owns property and versus a company. So one of the negatives in buying in trusts or self-managed super funds or companies is that there are extra costs. There can be extra land tax. So New South Wales is really strict with land tax, and discretionary trusts typically pay land tax from the first dollar. There's no land tax exemption. In Queensland, the discretionary trust, I think it's 350,000 land tax, and that's the land value, not the building value. So, if you've got 350 grand land value, maybe that means that you've got, a $900,000 property, and you can save on land tax by buying in multiple states. So land tax is typically a state-based tax, and unlike payroll tax for large businesses that employ lots of people, it's not prorated. So, you could have 7 properties in New South Wales and be paying $80,000 in land tax, $120,000 in land tax a year, or you could have 1 property in each state and be paying $0, or $10,000 in land tax. It can make a very significant difference with the land tax. And land tax typically is more in a family trust or company or self-managed super fund. So typically, you're going to pay extra land tax for these structures. You might pay it's quite likely you're going to pay a slightly higher interest rate because there's more risk in the structures. When you're buying through a trust, you are typically going to be asked for a personal guarantee anyway. So the bank might attack you personally, but at least, as we've said, you might be able to buy more property. And the third extra main cost is the accountant's fees to set up the structure and manage the structures. The family trust and trustee company, or the super fund and trustee, and there can be also extra costs for a bare trust deed and a bare trust trustee company. It can seem like a lot, basically with a self-managed super fund borrowing, you have 4 separate structures. Most of those, basically 3 of those 4 structures don't do anything. That you've got your self-managed super fund that really, collects the rent and pays the capital gains and does everything. You've got a bare trust that owns the property itself. And then after you pay the loan, you can often get concessional stamp duty often and transfer that back to the self-managed super fund or sell it inside the bare trust. And then you've got 2 separate trustee companies that just don't do anything every year, and you pay ASIC fees on. The self-managed super fund trustee, you can get a concessional rate, but the bare trustee, you can't. You pay the regular ASIC company ongoing rate. Next questions. Interested in advice on 2 approaches. Option 1, if I'm rent vesting first and plan to buy a home to live in later, would you recommend starting a family trust structure now for rent vesting? Obviously, each person's situation is different and like to, do a full assessment and work it out. But basically, yes, the family trust could allow you to buy more properties and then grow your assets more. And then, then you can sell down for a large deposit to buy your principal place of residence. Option 2, if I'm interested in buying a home to live in first and then starting an investment property portfolio, should I use a family trust structure later for those investments? Again, depends, but yes, because then you might be able to purchase more properties. And typically you don't want to purchase a property that's going to be your principal place of residence inside of a trust, because the trusts can't get the main residence exemption. And you want to be very careful if you're going to do a property you want to live in later inside of a self-managed super fund, because you really, really, really cannot do anything wrong in your self-managed super fund. Otherwise, you can be taxed 47% on the assets, not even on the income. So there are very, very strict rules on self-managed super funds, which we help people get through if they're made into a mess. If you drive in the wrong direction for an hour, you can come back. If your car, and if you fly to Melbourne when you catch the wrong plane, you catch the train to Melbourne rather than Brisbane, or like in Home Alone 2, he goes to New York instead of where the family's going in Florida. That's not an unavoidable situation. But if you do the wrong thing in your self-managed super fund, or your self-managed super fund, then it is like sending a rocket to Mars. If you put money into your self-managed super fund by accident, it's kind of like, there's a rocket gone to Mars. You can't necessarily just say, oh, whoops, didn't mean to do that, pay it back. There are serious consequences. Follow-up question about, again, using family trust. Which approach would carry a lower risk from a bank lending perspective? I think from the bank lending perspective, the family trust has a slightly higher risk to them because you're one step removed from you personally. And that's why they make you sign a personal guarantee. And so, one of the services we offer is potentially when, those letters come in that says you need an accountant to explain the structure to you or sign off that you've had the structure and the risk explained to you. That's something that we do. So from a bank perspective, the risk is higher in a family trust or a self-managed super fund. But for you, the risk is kind of the same, but maybe slightly lower because it's one step removed from you personally. I have a client who unfortunately purchased in a mining town, and they lost a massive amount of money on the sale. And so they still have this massive debt, but because it was in a trust, there were some ideas that they might be able to have the debt extinguished. And they haven't been able to do that after 6 or 7 years, but there was the potential that because it's in a trust, you could argue that the bank didn't do the right thing, or you could not pay the debt, or, there's sometimes in a structure, there is slightly more protection, or it's slightly harder for someone to get at you and your personal assets when you own things in structures. Now, are there any other questions here, and I want to open it up that it is possible if you want to ask a question verbally rather than in the chat, you can unmute yourself and ask a question. And if you don't, that's completely fine.
Hey, Scott, just wanted to follow up on that, Scott. So with those
Yeah.
two options, I suppose, let's say if an individual have an ambition and a goal to increase their portfolio, having to buy the first home, obviously that means most of your capital is depleted with the down payment, right? And you may
Yeah.
not have enough to, start the structure in the future. Whereas what I understand, correct me if I'm wrong, if we go with the option one in this particular instance, you don't buy the first house, but you just go and do a rent vesting and start the structure. And in the future, you sell a few properties and then you start later. Just want to understand, like, I
Yeah.
suppose which option from a commercial perspective, you're better off to increase the portfolio.
Yeah. Using the family trust first to then retain the capacity to buy the home later to live in is a way, is the way that I'm suggesting in this webinar can be more advantageous. And obviously what people who haven't heard the webinar or don't know about family trust would do is they might buy the property in their own name and maybe they try to live in it for some time to get the main residence exemption or not. And then they sell it at a later point. And if there's some main residence exemption, they can reduce the tax. If there's not, they're paying capital gains tax and they're getting, let's say they've got 32, 39 and 47% rates, but we're getting a 50% capital gains exemption because you've owned it for more than a year, then they're paying, just going to make these into percentages with there we go. So they're paying 16, 19 and a half or 23.5% on that 32, 39, 47%. And so, that's not bad, but the point is that if you buy in the family trust, you might not need to sell. Or if you buy in the family trust, you might be able to sell and then split the income with your lower earning spouse or a self-funded retiree parent or other relative potentially, or put money into a company. Often people with multiple properties and trusts, they might be building up losses in a trust. So this idea of purchasing multiple properties in trusts with the property being cash flow positive, that's not always possible. So you might be building up losses in your trust of 5,000 a year or 7,000 a year, and then over time that loss reduces. We're increasing the losses in the trust that we have, but then eventually you might sell the property and make a gain, and you can apply the capital gains discount in the trust before you apply the losses. So then the difference on that can be given to an individual. You can distribute capital gains and franking credits separately in a trust to all other income, and you can distribute any type of income to a company, but with a company doesn't get a capital gains discount. So a company typically is going to pay 30% if it receives a capital gain. So very often that's much higher than the 50% capital gain rates from an individual. The one benefit of a company in receiving distributions from a trust is that even though you might have to pay it back over 7 years, what a company can do can allow you to smooth out income. So let's say that your income is above 250,000 personally. And so in addition to the top 47% tax rate, you pay what's called a Division 293 extra 15% on your super contributions. So you've got to pay, let's say you put in the maximum 30,000 and your super fund pays 4,500 on that contribution. If your income is above 250,000, including any rental losses, you have to choose to pay another 4,500, another 15%, either in your personal name or in your super fund. And so sometimes putting money into a company, even though you don't get the discount, is a way to get franking credits and then later pay out a dividend when you retire and so on. So a company can also kind of be used as a kind of like a second super fund that has less legal requirements. Is that helpful? And did you have any further questions about that?
No, thanks, Scott, for clarifying that.
So every journey is going to be different. Every time you grow a business or you grow a property portfolio, it's going to be a different season in terms of the investing clock, whether people are gloomy or buying. There's always greed and fear in markets, and fear is the more powerful motivator that causes things to drop down. But when there's blood in the water, you can get a bargain. And also with assets that are growing in value and the economy is behind them, like property, Australia is so tiered on property that even if they cancel the negative gearing or tax the family home, they're surely going to do so in some concessional basis. So, just property has this massive ability because you can claim the deductions, because you can borrow at sometimes, under 7% rates. The self-managed super fund commercial property rate you can borrow in your self-managed super fund for under 7.5%. And so, I think it's really beneficial to do that because, you're paying less tax. Plus, when you retire, it can be tax-free. You're not taxed personally on that money and you ignore it from your personal return. And there's just so many levers you can pull with property that you can't necessarily pull with other wealth creation vehicles. Like obviously business, you can make a whole bunch of money and put it through trusts and reinvest into business. And, there's things you can do with business, but there's extra things you can do with property because of the leverage behind it and the potential to borrow off that leverage. You can't go to the bank and say, hey, I want to invest 500 grand into my business. Hey, give me the money at 6%, 7%. They're not going to do it because they know the business is more risky. But with property, the bank knows that there's much higher ability. If they need to sell the property, they'll be at least able to recoup their money. So they're very happy to give 30-year loans at very low rates, as opposed to business where it might be like, look, here's either we're not going to do it, or here's a rate that's between 12 and 18%, so that you can go and do some Facebook ads. Look, that has come up to almost an hour. Yeah, if you've got any further questions and you want to put them in the chat, you can do that. And otherwise, I think we end it there. If you've got any feedback, please send it through via email. If you're interested to consider if a family trust or a self-managed super fund could be the right structure for you, and you're interested in growing your portfolio or potentially refinancing, again, reach out by email or give me a call. I'd love to have a chat. Otherwise, thank you very much for coming. Look forward to chatting to you soon.
Thank you very much.
All right, great. Thanks, everyone. I'm just going to end the meeting now.